Hey, how's it going, everyone? Welcome back to the Dividend Compounder Show. Today, we're going to be looking at Dollar General, ticker symbol DG. They're currently trading for about $75 a share. Depending on when you watch this, they might be lower or a little higher. And in this video, we are going to be looking at the intangibles, the finances, and run some valuation models to figure out if it's a delicious or a disgusting dividend stock. And the reason why we're looking at Dollar General is because they are currently trading near their 52-week low. Meaning in the past 365 days, they are near their lowest price ever at $74, the low is $72. And not only that, the PE ratio is 11, and the dividend yield is 3.1%. So I think it's worth investigating. And we're going to be doing things a little differently because I watched other videos on YouTube about Dollar General, like the stock analysis, and everyone looks at the numbers and finances exclusively. But here on this channel, we dive a little deeper and we look at the intangibles, the story, the future, the prospects, because all of that is also important to evaluate a company's stock. So what exactly is a Dollar General? As you can see on your screen right now, it says, hey, we're proud to serve as America's neighborhood general store. Founded in 1939, we serve you by providing access to affordable products and services for its customers. In other words, you want to think of them as a convenience store and to a lesser extent, a mini Walmart. And if we scroll down right here, you can see a map of all their locations. This was current as of 2023. When you walk into a Dollar General, you're going to notice that the items are what you would see at a Target, CVS, and Walmart. Consider me lucky and highly blessed, but I've actually had the opportunity to visit a Dollar General a handful of times. And I would say that their offerings are priced at a premium because of the convenience fee. So even though the name says that it's a Dollar General, it's not necessarily the case. Because as they sell stuff like the toothpaste, cereals, and snacks, it costs more at a Dollar General than it would at a normal store. So the name of the place is misleading in my opinion. With that said, according to the company, about 20% of the store's products are priced at about $1 or around that range. And the rest, the 80% of the products in the store, they're all over the place. So you can pretty much buy anything from dog food to laundry detergent at a Dollar General. And they have about 20,000 stores across North America. And they specifically open up their stores in areas where access to a Walmart is not a thing. Meaning their locations are usually in one of two places, right? Number one, they're either in the hood, aka the bad part of town, but also they open up in very rural areas where the town population is less than 500 people. So their target demographic is not the same as what Target and Walmart are aiming for. And on that note, Dollar General's average customer, they earn about $35,000 a year. So if you don't get it by now, Dollar General aims to serve very low income customers. And they specifically open up a location to meet an unfulfilled demand. Because think about it, in the middle of nowhere in Kansas or in the hood, when you open up a Dollar General, there's not going to be a Walmart nearby, which means they have a monopoly. They're like the only place where you can go to buy what you gotta buy. Unless we're talking about a Dollar General that's located in the hood. Then of course you could just go up the road and visit a rival or a competitor and buy what you need to buy over there. But for the most part, a Dollar General upcharges their products for that convenience fee because they're usually going to be the closest thing to your house or to your neighborhood. Especially so if you live in a small town with less than 500 people, and Dollar General is usually the only thing you have available there. So as you can see on your screen right now, it kind of looks like a Walmart, right? But if you think Walmart is also aiming for the exact same population and target customer, then you are very wrong. Because to put it into perspective, the average household income for a Walmart shopper is usually $62,000 to $65,000 a year. And for Target, then it becomes $79,000 a year. All that to say, it's not going to be unusual to have a Dollar General customer also shop at a Walmart, but you're not really going to see a Walmart shopper go to a Dollar General. Does that make sense? I think by this point, we should all understand that Dollar General opens up locations in places where the average customer earns less than average and in physical spots and locations where their competition do not care about. So I would argue that's an economic moat, but it's a moat around a customer base that isn't the most desirable to other retailers because of the spending potential is not lucrative. And to prove my point, catch this. The average amount a customer spends inside a Dollar General on a typical visit is around $15. So the growth story to me is not very compelling to say the least. Unless, of course, you're bullish and excited around the idea of small towns in the US. And your theory isn't exactly wrong, because the price of a home in a major city like Minneapolis or Milwaukee or Miami, yeah, it's gonna cost a leg and a nipple. So maybe that means more people will move to rural areas so that they can eventually afford a home. And according to the US Census Bureau, about 20% of the nation's population resides in rural locations, meaning the other 80% are in suburban or in urban areas. But depending on how people feel about cities in the future, that could change, right? The 20% could grow to like 25 or even 40%, which means right now, statistically speaking, some of you have never even stepped foot inside of a Dollar General before. So what you see on your screen right now is what the outside of a typical Dollar General in a rural area looks like. It's not very clean and it's not very flashy, but everyone knows what a Dollar General is in small town America. Unfortunately for me, I lived in the state of Mississippi before, and there were Dollar Generals everywhere. In a 20-mile radius, there was no less than about 8 to 10 Dollar Generals. And the thing is, when you walk inside, the aisles look like a tornado ripped through the store, and they are perpetually understaffed. Even when you wanted to check out, there usually wasn't a worker in the front because they're too busy juggling, 20 different tasks because the stores intentionally underhire. And I think that's by design so that they can save on overhead costs of not paying employees during slow hours. And it makes sense, but it's also evil big corporate, right? Because if you're trying to run a profitable Dollar General in small town Arkansas that only really sees like 20 to 40 customers a day, do you really need 3 to 4 workers? Probably not, right? You can get away with one, and I just think that's it's icky because you're stretching that one employee really thin, and I don't really like it, but that's neither here or there. So for me, when I lived in Mississippi, I would personally go out of my way to visit a Walmart, a gas station, or a Costco instead for whatever I needed because the Dollar General shopping experience was a headache. On the other side of the spectrum, a really good shopping experience is like at Costco or a Target. Actually, I take that back. If you go to a Costco at 5 p.m. on a Saturday or even in the mornings on a Sunday, you'll quickly realize that's a terrible shopping experience. But if you go to Costco in the weekday at like 11 a.m., it's pretty peaceful and it's pretty calm. But on that note, Dollar General is making a small pivot into becoming a mini grocery store because they are finding out that if they sell fresh fruits, veggies, and predominantly grocery items instead of being like 5% like it is right now, if they become like 25 or 30% of their retail space to be allocated to grocery items, then, oh my gosh, that was a mouthful, then the frequency in which customers visit will be increased. And it's going to be good for their overhead costs because grocery items tend to be high turnover on the shelves. Whereas if you try to sell an electric razor for $60 or a vacuum for $40, it could potentially sit on the shelves for months until it sells, which just takes up space that you're paying rent on. Whereas a jug of milk or apples will sell within a day. So by offering more fresh groceries, they're increasing traffic with their targeted customer base, and each visit is going to be an opportunity to sell something else besides the grocery item. Because if you're going to go in there to grab a carton of eggs and you see a toy that your kid wants, you might end up buying that toy as well. So their strategy and vision, it makes sense. And Dollar General is making this pivot because right now, their operation and mission is to help people fill in the gap with random purchases like cigarettes, snacks, and household essentials. In a small town, a Dollar General is usually a mile away from their house, and the closest grocery store is going to be around 10 to 20 miles away. So Dollar General understands that they're not designed to replace a person's big grocery cart with all of the essentials and grocery list items, but instead, its purpose is to sell random things a person might need in between their big shopping days at a big box retail store like Walmart. if that makes sense. That was a mouthful, but I hope you get it. And to expand upon that point, in a normal Dollar General, they have about 10,000 different SKU items. Inside your standard Walmart, they have about 140,000 SKU items, meaning different products for sale. Walmart is a beast on a whole different scale, so you can't really fairly compare Dollar General to Walmart apple to apple. So like I alluded to earlier, it's safer and more fair to just think of Dollar General as a convenience store, and it'll make sense. All that to say, by making this transition to becoming a small grocery store while also providing low everyday priced goods, they're hoping to increase their revenue. That's the growth driver, because this company has been going through headwind after headwind, like inflation, retention issues, staffing issues, the pandemic, supply chain problems, and the bad news just won't stop beating on this company. But anyways, the pivot to grocery stores, that's the growth driver. And if you can't tell by the name of this channel, we love dividends. So let's go ahead and check out their dividend over the years, their dividend profile. So for every share of Dollar General that you own, you get paid $2.36 in dividends, which I think is not too bad. And the payout ratio, I think, is spectacular, fantastic, above average, 36%, which tells me that the dividend itself is sustainable and it's healthy. I don't see any sign of the dividend being cut anytime soon. And on average, Dollar General grows this dividend payout of $2.36 by 13% year over year. And here's the cool thing about this company. Back in 2015, the dividend was 88 cents a share. And because they've been increasing it very aggressively since then, now we're looking at a number like this, $2.36. And the average payout ratio for the past 9 years has been 20%. So right now it's a little higher than average, but they've always kept the payout ratio really low, especially when you compare it to other retail companies. So their dividend, I would say, is a huge green flag, like having 3 nipples. My goodness, that is delicious. All right, so the dividend looks good, but what about their adjusted stock price total return? Well, year to date, they are down by 43%. Not good, I know. But 1 year out, 38%. Negative, by the way, negative 38%. What about if we zoom out 5 years? Oh, the story does not get any better. Negative 50%. Okay, last chance. What about 10 years out? From 2014 to 2024. Then it's up by 25%. So the total return, the performance of this stock has just been atrocious for the past 2 years. It looks like all of the gains that they ever made from like 2015 all the way up to like the beginning of 2023, they were trading for about $251 a share, adjusted stock price, $251 a share. And since then, they just melted all the way down to what they are today of about $74 a share. So the dividend, green flag, total return and performance itself, red flag. So what we're looking at here is like a beautiful hot woman who's just absolutely crazy. So far, one good, one bad. And now we're going to be looking at their debt situation to figure out if it's manageable, do they have too much? If this company runs into further headwinds, will they be able to survive and be financially okay? Anyways, we're going to be considering the debt to equity ratio to determine that. And as of right now, it's a 0.86, which tells me that it is awesome. Their debt is not too crazy. However, when we look at the story of their long-term debt, which is the first bar graph that you see on your screen right now, back in 2009, at the tail end of the Great Recession, they had about $4 billion of long-term debt. And since then, it's been going down, right? Which is a really wonderful thing that you want to see. However, as they started facing those issues like staffing problems, retention issues, supply chain, inflation, pandemic, and all of that, look what happened to their long-term debt. So that right there is a yellow flag, but their debt to equity ratio itself is a green flag. So I would say their debt is not too crazy, but it is something that you want to be mindful of because it is increasing. Because during their golden era of about 2014 to 2020, their debt to equity ratio was sitting at around a 0.46, which is really good. You guys have no idea how good that is. But to see that picture turn into a 0.86 and a 100% increase, not good. But as things are right now, I would say their debt is good. However, if this trend continues and it increases by another 100% and it's like a 1.6 and then it turns into a 3.2, then this would not be a good thing. And the next thing that we're going to be looking at is the revenue, the top line. What we want to see is a positive trend or the revenue to be going up year over year. And in the case of Dollar General, yes, that does appear to be the case. So back in 2010, they posted $11.7 billion of revenue. And since then, it's just been going up. Despite the headwinds and despite the stock price getting obliterated, they are still going up. It went down a little bit in the beginning of 2021. It went down by negative 0.5%. And they had 2 consecutive quarters of red. And then they were in the green year over year by 3.8%. And as of right now, they posted $39 billion of revenue. So this company is generating sales and revenue, and the top line is going up in a really beautiful picture. I'm genuinely surprised by this. I did not look this up prior to making the video, and just seeing this trend right here tells me on surface level, this company is thriving and doing pretty well. And the next metric that we are going to be considering is their profitability. Are they turning a profit? We're going to be looking at the gross margin, which is the first graph that you see. And it looks like for the most part throughout their history, they hovered at around 30% gross margin, which is the production efficiency. And it seems as if they reached the peak of a gross margin of 32% back in April of 2021. Since then, the gross margin has just been decreasing year over year. And as of right now, it's sitting at 29%. However, what's important is the net margin, because that tells us the profits after all the expenses are taken out. And right now, that net margin, which is depicted by the third graph, the one on the all the way on the bottom, is 3.5%, which is not exactly good, but I come from a supply chain and retail background, and I can tell you that's pretty normal in retail. A single digit number as your net margin seems to be the case with Walmart, Target, Costco, Sam's Club. It's just the way things are. So the net margin is not really a red flag at 3.5%, but what is a red flag is that they usually operate at about a 5% net margin, meaning a 5% profit after doing everything, the cost of marketing, paying your staff, paying for the items, paying for the truck drivers. The profits left over is 5%. And then it reached a peak, obviously, back in 2021 of almost 8%. But for it to be decreasing year over year, this is not looking too good. So I would say when it comes to their profitability, it's a yellow flag because they are profitable, but they are trending towards the wrong direction. And I would argue maybe in the next 3 to 4 quarters, if they don't figure this out, their net margin could be sitting at a 1% or worst case scenario, be at a 0%, which is what startup companies are, right? Startup companies promise high growth, but they're not exactly profitable yet. But for a mature company like Dollar General to not be profitable, that's going to be a very messy picture. So I would argue they have about 3 or 4 quarters to go until it reaches like that catastrophic number of 1%. But in the meantime, as they hit that 1%, this stock price has the potential to go down even further. I'm talking about from 75 down to 60, down to $35 to even maybe like $10 a share. I don't want to be a doomsday sayer, so let's just move on to the next metric. I don't even know you, and I just wanted to apologize because I feel like I just came off really negative because for all we know, Dollar General could turn it around and be a rocket ship again, or just be a very profitable and a cash printing business in the future. So let's just be optimistic, not so cynical, and I'm so sorry. And now the last metric that we're going to be looking at before running some valuation models to figure out the intrinsic value, we're going to be looking at the shares outstanding. Essentially what you want to see is a company buying back their shares so that they're not diluting the shareholders. That way, each share that you own has quality over quantity, and it's going to help their earnings per share. In the case of Dollar General, yes, that does appear to be the case. So there's 2 bar graphs, right? This one right here tells us how many shares there are. So back in 2010, there were 344 million shares outstanding. And then on the bottom graph, it tells you by how much they decreased the shares outstanding every single year. So in 2012, they bought back about 1.7% of the shares outstanding. And every single year since 2012, they have been buying back the shares very aggressively and very consistently. From what I can see, it seems as if Dollar General really prioritizes the shareholder because not only is the dividend growing double digits and the payout ratio is still very safe at like about 30%, but the shares outstanding, the Dollar General has bought back about 100 million, 125 million shares since 2012. So the shares outstanding, pretty good picture despite what they're going through right now. And now we made it to my most favorite part of the video. We're going to be running some valuation models to figure out the intrinsic value for Dollar General, to figure out is it actually undervalued and if it's a delicious or a disgusting dividend stock. The first one is going to be the multiples valuation. The median PE ratio for the industry peers is a 23, and I think right now Dollar General's PE ratio was like 11 or something, right? Something ridiculously low. With that taken into consideration, their multiples valuation should be $148 if they were priced similarly to their industry peers. The next one is going to be the discounted cash flow analysis model. Basically, the free cash flow is going to tell us how much this company is worth. And I was surprised when I was plugging these numbers in from doing my research on the company. Up until 2023, Dollar General was a very cash-heavy business. Dollar General was a free cash flow king. However, their free cash flow has been declining very fast and rapidly. As you can see, from 2021 to 2022, it declined by 36%. And then the next following year, it declined by 76%. And now, finally, they're going back in the right direction, and they went up by 62% year over year, from posting $429 million last year, and this year they posted $698 million of free cash flow. And you might think like that sounds awesome and it's really good, but when you compare it to the numbers that it was at, even just like 3 or 4 years ago, then you can see that this is a bad thing because it's going down and it's a lot lower than it used to be. Anyways, the DCF price for Dollar General is going to be $26.40 if they continue this pattern. The next one is going to be the dividend discount model. The dividend and the growth thereof is going to tell us how much this company is worth. And the dividend is where I do need to give my props and praise to Dollar General, because for the most part, up until 2023, they were doing a spectacular job navigating and increasing the dividend. But with that said, from 2023 to this year, they decided not to increase the dividend, but rather to sustain the $2.36 for 2 years in a row. And I think that's the right decision. If they decide to be greedy and say, hey, we're going to increase this dividend even though we're going through so many issues and problems, then I would question the leadership. But because the leadership decided to just sustain it rather than freezing it and cutting it, it shows me that they're mature and that Dollar General has a good leadership team guiding the ship. Okay, well, anyways, the intrinsic value based on their dividend is going to be $48.62 a share, which brings us to the last valuation model, Benjamin Graham, and that's going to be $77.76, which is so scary because that's very close to how much they're currently trading for. Which brings us to the conclusion. Jimmy, you gotta hit them with the drum roll. By the way, when I do that, I am literally taking both of my hands and beating them on my nipples, and that's why you hear, based on all of these calculations, is going to be $75.23 a share. And they're currently trading for about $75 a share. Depending on when you watch this video, Dollar General could be trading for lower or a little bit higher. But as of right now, $75. And the Wall Street analysts believe that Dollar General should be worth $101 a share. So we're a little cynical, whereas Wall Street is a little more optimistic. So with that said, after hearing everything and considering their intangibles, their story, and their finances and numbers, let's just try to figure out what's an acceptable buy price so that we don't overpay for the company. So $75 a share with a 10% margin of safety baked in, then the acceptable buy price becomes $67 a share. But let's go ahead and plug in the Wall Street number of about $101 a share. At a 10% margin of safety, then the acceptable buy price is $90 a share. So if you look at this company with an optimistic lens, then this would be the buy price target. And then if you buy it at $75, then dude, you're getting a $15 discount. And if you were to consider it the way I say, based on our calculations, then you would say, hey, right now, Dollar General is overvalued by $7, and you would pause. So after seeing everything, if you are thinking that Dollar General is an undervalued retail store, you're not necessarily wrong. Like, especially when you compare them to their peers, they're really undervalued. But I think they're undervalued for a good reason because their growth and their numbers and their profitability is not the same as their competitors, such as Walmart or Target. But then again, I would argue that Dollar General's competition are gas stations, Wawa's, 7-Elevens, and other convenience stores like Buc-ee's. So if you like the future of that sector, then I guess it makes sense because Dollar General will be the most convenient option in lieu of driving more to access a Walmart, especially if you're bullish on rural areas and a retail store that intentionally serves the rough side of town. But do keep in mind, if you buy Dollar General right now, you would be buying them during their worst moment when everyone else is fearful, and fearful, some people would say, for good reason, because Dollar General have lowered their guidance and forecast. They struggled with people stealing their merchandise because they're like, hey, there's no cashier, so I'm just going to walk out with my items. Their profit margins are shrinking year over year, and they're navigating inventory issues as they try to make this pivot to becoming a small grocery store outlet. So what's my personal take? I think on paper, I can see why people would want to invest into them, right? For the rebound and the turnaround story. The numbers make sense. Somewhat. They make sense. But for me, the investing thesis and future prospect is not my cup of tea. I am not bullish on Dollar General. I think their growth story is absolutely over and they're oversaturated. I think they built all the locations that they can feasibly build without being right next door to each other in all of the rural and underserved markets. Even if they penetrate every rural addressable market, I'm still not convinced, especially after I saw their total return performance for the past, 5, 10 years, even year to date. I don't know. Wall Street is fearful of them, and I'm kind of scared to touch this stock as well. So for me, this is a pass. Even if it dips further, I'm just not interested. Unless their story changes, unless they start, probing into e-commerce or doing something crazy, I'm not interested. And I know when you hear that, you might be like, screw this guy. What does he know? Small Dick Joe? But to that, first of all, calm down. Put your shirt back on. That's disgusting. Nobody needs to see your man boobs. To that, I want to say this, okay? Let me defend myself. There's way too many YouTubers out here that are creating sensational titles and thumbnails and pumping every stock under the sun and moon, especially stupid stocks that they are bag holding. For me, I would rather be truthful, honest, and tell you, amigo to amigo, that if I don't like a company, then I'm just going to be neutral and say I don't like it, but I can see why someone would like it. I would rather be that guy. But on the other hand, I'm going to tell you this right now. If Buc-ee's or Wawa ever decides to become publicly traded, then that would grab my attention. And unfortunately for Dollar General, I'm sorry. I don't know how to reject people. Do you see how long-winded I am to reject someone? But yeah, so that's what I think about Dollar General. And after doing my research and homework, I'm not interested. At first, off a surface level, I was like, dude, the PE ratio, phenomenal. They're on a 52-week low, and the dividend profile, like the stuff on the surface level looks so good that I needed to look into them and read their story and their future prospects to figure out if they really are good or not. And dude, I'm just not feeling it. Anyways, this has been a Dividend Compounders with Cheese episode. I hope you enjoyed it. If you like this type of content, dude, come back to my channel versus the competition. We really go deep when we research companies. We don't just look at the numbers. We look at everything to consider if it's a buy or not. Anyways, I'll talk to you next time. Stay safe. Keep your shirt on.